Hello, everyone, and welcome to today's webcast sponsored by MassMutual Wealth Management. I'm Kirsten Chang, Senior Industry Analyst at VettaFi, and we are diving into a hot topic this season. We're talking about politics and your money. We're talking election years, the economy, and your portfolio more specifically. We'll give you a deep dive into election year myths and misconceptions and help debunk some of those. We'll explore whether investors should avoid election years altogether, and we'll talk about the actual real economic impact of elections. Before we kick things off, though, I just want to go over a few housekeeping items with you all. First off, if you have any questions of your own for our speaker today, don't be shy. Feel free to ask. Just type your question in that chat bubble at the bottom right corner of your screen, and we'll try to get to as many of those as we can. And I see some of you already figured out our other reaction feature here, the emojis. For those of you joining us live, you'll also notice a little heart icon at the bottom of your screen. That's our reaction feature. If you click on that, you'll see the emojis that you just saw that allow you to react in real time to what you're hearing whenever the mood strikes. So feel free to test out those thumbs up or smiley face or heart emojis at your leisure. We love to see it. I should note that all the slides you see today, as well as a recording of the full presentation, will be available on demand later this week. You'll receive an email notification once those are out. You can also download resources by clicking on that folder icon, love those emojis, keep them coming, at the bottom of your screen, where you'll get access to additional material on presidential elections, learn more about MassMutual, and get tips for how to financially prepare for an upcoming election. Periodically, we'll be asking for your input in the form of live polls. You'll hear a little ding when those questions go out, so keep an ear out, and your answers will often help drive our conversation. We do have a survey we encourage you to fill out anytime throughout the webcast. You can find it right below the media player on your left, or you can click on the clipboard icon. So please don't forget to give us your thoughts before you leave today. Lastly, if you're here for CE credits, look no further. Just be sure to click on that certification icon. It looks a bit like a mortarboard at the bottom of your screen. You should see a green check mark appear once you've completed everything needed to receive those credits. Now, allow me to introduce today's presenter. Daken Vanderburg is CIO of MassMutual Wealth Management. Daken joined the firm in 2019 and brings more than 2 decades of industry experience to us, having served in many different key roles over the years. But right off the bat, I want to bring the audience in with a quick poll, our first of the day. We want to know, how are you feeling about the current state of the economy? People are quite divided. Are you in the recession camp? Do you think that we will achieve a soft landing, so slower economy, slower growth, but not too severe a slowdown? Or are you just not sure? And Daken, while I give everyone a chance to answer that question, just want to say hello to you and happy Thursday. How are you doing out there in Connecticut?
Hi, Kirsten. Great to see you, and thanks for having me. Hello, everyone. Thanks for joining. We have an interesting number of topics to talk about. I sort of call this unprecedented times in lots of ways. So should be an interesting conversation. And thanks, Kirsten, for having me today.
Of course. Thanks for being here. Let's go to the poll results. Again, how are you feeling about the current state of the economy? Are you in the recession camp? Are you in the soft landing camp? Or are you not quite sure? It looks like most of you are in the soft landing camp. So quite a few optimists here. So slower growth, but not too severe a slowdown. So that's nice to see. So Daken, feel free to give us your quick reaction to that, and then tell us more about the current market environment we're dealing with here. I mean, just the election's just less than 40 days away.
Sure. So a couple of comments. First, on the poll itself, all data seems to point to that. I agree. We have a slight tick up in unemployment. The economy is slowing just a tad. With that said, so many things are so different relative to past cycles, and we are in a really interesting, somewhat trepidatious time. So I think I tend to lean towards it's likely going to be a soft landing. The Fed's done a reasonable job of slowing things down and trying to bring down inflation. Nonetheless, there are a bunch of risks out there right now. And I think there's a lot of misconceptions, there's a lot of hyperbole, there's a lot of sort of noise around the economy and what's taking place from a political standpoint. So we'll get into that and spend a little time trying to slow things down. There's just so much misinformation out there. We're going to try to use data today to just look at, provide some perspective and talk a little bit about where we've come from so that we can turn to where we're going potentially, and offer a little perspective as we go. So I think I'd start with sort of the first chart here, which is a little bit of the background, right? So before we get to where we're going, we got to understand a little bit where we've been. So, the thing that's been so remarkable is 2022, as we all have lived through, COVID-driven, inflation-driven, really challenging markets. What this chart shows is every single line since 1977. The orange line is the 2022, and everyone kind of knows this chart, right? The S&P 500, the sort of dominant equity market in the United States, just got clobbered. Really, really difficult year in 2022. What made it so challenging is the next chart, and that's the bond market, right? A lot of investors, typically, especially those that have sort of historical portfolios of bonds and stocks, rely historically on sort of bonds to be a ballast. So when stocks go down, hopefully bonds go up. And there's sort of this conception that that's the case. And what happened in 2022, what made it so challenging, same exact chart every single year since 1977, think of it as sort of the growth of a dollar. And bond, it was literally the worst market since 1977. So what made 2022 so challenging was because not only did stocks get clobbered, but bonds got clobbered as well. And there's almost no place to hide, right? That's sort of the experience we've lived from and lived through, and why 2022 was so challenging. I think the interesting question, which will bring us to where are we today at some point, is what happened? Why did this take place? Why did this occur? Why did we end up in a position where we had this unprecedented event, COVID, no one had predicted it by and large, and yet that spiked inflation, and then that sent money supply flying, and all of these things were moving around so quickly. What took place? What really happened? So here's sort of the obvious chart, 12-month change in US inflation. CPI is the measure that I'm using here. It's not a perfect measure, but it's fine. Think of it as it's really sort of the indication of a basket of goods, right? Our prices moving up. And we've all felt this, right? We've felt it from health insurance to rent to homeowners to you name it, have felt it in lots of different ways. And we saw prices go up. We all know that. And now prices have gone down. What I want to make sure is clear is there's sort of this common conception of prices going up is this definition of inflation, but there's a more important version of this. Think about it this way, Kirsten, which is imagine if I walk into a store, I've got $10 in my pocket, and in that store I can buy 10 loaves of bread. Pretty straightforward, right? Let's just say one loaf of bread costs $1. Then the very next day, let's say I walk in with a brand new $10 and I try to buy 10 loaves of bread. And that day I can only buy 9 loaves of bread. So what's happened? The thing everyone knows is that the price of bread has gone up. We know that. That's sort of very common reality. The other piece of it, which is almost more insidious, is the value of my dollars has gone down. The value of the cash in my pocket now has less purchasing power than it did before. And that's why it was such a challenging environment, is that prices went up, yes, but the value of those dollars went down. And that's really what this perception of the increase in inflation was. And that is what's so challenging about it. There are a number of different reasons why. This is maybe the most important chart in the entire deck until we get to the end. One of the big drivers was the US Federal Reserve balance sheet. We have a very simple tool that the Federal Reserve uses, which is, I'm simplifying to be clear, but basically they turn on a machine that sends out dollars. They walk across the hall and they buy bonds. And those people that held bonds now own cash because they give them cash for those bonds. And that floods the market with liquidity. New dollars make its way out into the economy. Is that positive? In some ways, yes, because we all of a sudden have new dollars that's sort of flying around. But what's the reality of that? The reality is that we created so much currency, depending on which budget office, between fiscal and monetary stimulus we believe, somewhere in the neighborhood of $11 to $13 trillion. Remember, the entire US economy is around $26 trillion. So if you sort of visualize all of the currency in the world on a table at one point, and I put, let's say, 40% new dollars on that table, what happens? The value of the dollars goes down. Nothing else has really changed. And that experience is that we, as people who are buying goods, again, that are priced in dollars, now have this experience that prices go up, right? So what happened then in 2022 is prices went up. Federal Reserve and lots of other people were sort of surprised at the speed at which that happened. They then raised rates really quickly. We'll get to that in a moment. And the whole market has to reset. Stocks get clobbered, bonds get clobbered. And so there's a reset, really sort of period that takes place, which we then sort of moved through. And that starts to bring us to where we are today. Does that make sense so far?
Yeah, perfect sense.
So from there, I think that brings us to sort of an interesting moment where we're in a period where not only had rates gone up really quickly, and this chart shows that, the price of homes went up really quickly as well, right? So people that own homes sort of felt like they were at one level, and then all of a sudden they were at a lot higher. And everyone talks about how much that went up and how valuable that was. And if you look at the Case-Shiller Home Index as an example, it's not coincidental that something like 40% was the increase in our money supply, and something like 40% was the increase in real estate. In other words, what are homes priced in? They're priced in dollars. And if you think of homes priced in dollars and the value of those dollars decline by roughly 40%, our perception is that homes go up by roughly 40%. That's not coincidental. There are a bunch of other drivers, but that is a really important driver of what took place. And for many, many Americans, home prices is one of the largest assets that we own, right? So home prices go up a lot. What does the Federal Reserve do? They increase rates really, really quickly. We'll get into that in a moment. This shows U.S. median home prices going back to 2000. What you can see is sort of the median was around 300 back in 2000, sort of ticked along, reasonable prices, rate of increase. And then all of a sudden in that COVID time period, boom, all of a sudden home prices really went up very, very quickly. At the same time, because the Fed had jacked rates up so quickly, mortgage rates go up, right? We all play this game. Back in the day, I had this mortgage that was 2.6%. I had this 2.8% mortgage. And all of a sudden they went from 2.6, 2.8 to 4, 4.5, 5, 6, 7%. So not only did home prices go up, but mortgage rates went up as well, right? Which sort of brings us to the conclusion and raises some interesting questions. In 2020, the median home price was $329,000. Mortgage rate was 2.8%. So the average mortgage was around $1,100, $1,074. In 2023, just 3 years later, the average home price was $479.5. Mortgage rates were 7%, and the monthly mortgage was now $2,552. That's an additional $1,500 per month, or almost $18,000 more per year, or over the course of about 2.5 years. And remember, the average American income pre-tax is $57,000. So we had rates go up, home prices go up, mortgages go up, everything's much, much more expensive. Even after inflation adjustment, there hasn't been a more expensive time for new home buyers in many, many, many decades. It's really, really challenging time. And the Federal Reserve is very aware of that. And that's starting to play in to where we are today. Okay, so let's sort of bring that section home. So what took place? Federal Reserve goes, whoops, that was a problem. Markets are a little bit out of control. Inflation takes off. Bonds start to sell off. The entire economy has to reset. Federal Reserve says we're going to raise rates really quickly. They do so. One of the fastest increases in the last sort of 50 years. Really fast increase in essentially what is the incentive to borrow or to spend. That goes up rapidly from sort of a base rate of close to 0 up to around 5, 5.5, 5.25. That starts to work. Right. One of the big drivers is money supply. We measure it by something called M2. You can see this massive increase going back to 1960 in the money supply. And then the Federal Reserve raises rates. Money supply crashes to the floor, as it should. All of a sudden, it begins to shrink. And that's when inflation starts to turn over. Home prices now start to settle down. They're still growing, but not growing as quickly as shown in this chart. This is a percentage change chart that shows how they were up a lot. And now they're still growing. They're still above the 0 line, but it is definitely growing much more slowly than it was before.
Yeah, on that Case-Shiller home prices, I think there's like a 2-month lag in reporting, but we did just hit another record high for that 20-city index. So to your point, continuing to hit those new highs. Yeah. Right,
which raises some really interesting questions. If you have a massive flood of liquidity and then a lot of that gets pulled out, if rates go up, if mortgages go up, why hasn't home market, for example, crashed? Why haven't we had a recession when rates went up so quickly? Why are we seeing unemployment tick up a little bit and the economy slow a little bit, but not the dramatic end to a cycle, to your poll that you raised earlier, that we've seen before? And that's really where the interesting questions sort of begin to come out when we talk about where are we today and what's likely to happen from here.
Yeah. So Daken, you put a lot of the macro data into perspective for us and given us a little recent history lesson, but where does that leave us now? Going back to that first poll, should investors, are they right to feel as confident as they are right now about current economic conditions and market valuations?
Right. So if I were to drop you in any economy, or drop any of us in any economy and say, hey, the market's up 20%, bonds are doing pretty well, inflation's pretty reasonable, economic growth is actually quite good, people are working, unemployment's pretty low. Should the Federal Reserve, let's say you only have 2 choices, raise rates or cut rates? It's not clear which of those it would be. It certainly wouldn't be cut rates aggressively because markets are doing reasonable things, the economy is doing reasonable things, and yet we've just gone through this moment where the Federal Reserve cut 50 basis points. I think there's some logic in what has happened. Nonetheless, there's a really interesting signal on what's taking place there. So to your question, Kirsten, that kind of brings us to where we are now, which is what's taking place and kind of what does this look like? Let's go back, same perspective. Again, every line in the S&P since 1977. And you can see the orange is still 2022. Let's overlay 2023, which is that blue line. Pretty reasonable market. Markets were up. 2023 was a good year. Same with 2024, also a good year. Let's look at the bond space. 2022, again, the most difficult bond market in the last since 1977. But 2023 and 2024, pretty reasonable. Things have started to solidify. Everything's a little more stable. How about growth, right? If I want to cut rates, Federal Reserve, my expectation is that I'm going to sort of push on growth. Growth must be low. This chart goes back to 1980 and shows U.S. growth, and it's fine. It's reasonable. That orange line is average growth over this full time period. And what you can see is growth was high coming out of COVID. It slowed. It has definitely ticked down just a tad. Nonetheless, it's reasonable. We have positive growth. The last GDP prints are going to be somewhere in the 2.8, 2.9%. Again, reasonable levels of growth. And importantly, the U.S. economy is very driven by the U.S. consumer, and U.S. consumers working. If you have jobs, you receive income. If you receive income, you are oftentimes spending that income or borrowing more against future income. And unemployment rate remains really, really low. People are working. This goes back to 1945, the end of World War II. And you can see it's not record low, but it's pretty close to record lows in terms of people being employed and people working.
And there are concerns about a slowdown in hiring. I think we're back to below pre-pandemic levels with that. So, I mean, I think that kind of speaks to the point of those who are in the recession camp right now, because usually you'll see a slowdown in hiring before you see the firing pick up. So I don't know how you think people should be feeling about the labor market overall at this current point.
Yeah, I think there's definitely first of all, there's some societal issues and sort of some class issues that I think are playing through, which are interesting. There's a fair amount of underemployment, which is interesting. But in terms of aggregate employment, when people are working, they're receiving incomes. When they receive incomes, they are supporting the economy. And the U.S. economy is very driven, depending on estimates, somewhere in the neighborhood of 65 to 70%, driven by the U.S. consumer. That gives us some confidence that the U.S. consumer will continue to spend and borrow and continue to do what U.S. consumers have done for the last several decades. Again, with the Federal Reserve now having raised rates so rapidly, and now with this really interesting move they've just done, that's clearly sending a signal that they feel like most of the inflation work is behind them, most of the inflation risk is behind them, and they're leaning heavily into, we're going to really support growth. If we're going to cut 50 basis points when everything is sort of okay and things are kind of reasonable, that's an important signal to say, and we've got more of these in our chamber behind us to cut if we want to the extent that we see more weakness in the, call it, labor market or in various forms of growth. And that's really leaning, remember the Fed has a dual mandate. We have stable prices and maximum employment. And that's really leaning on the employment side, on the growth side, and we really want to focus on that right now at the Federal Reserve standpoint, which very much to me means we're sort of in a risk on growth mode. That is the message that's being sent right now. To your question, leans much more in the, we may have a little bit of a slowdown given rates are starting to bite now. We'll get into a couple of those charts in just a moment as well. But nonetheless, it doesn't seem like a hard landing is the likely outcome, at least thus far.
Right. And right now the markets are pricing in, I think, a little more than 60% odds of another 50 basis point cut in November. So we'll stay tuned for that. With that, I want to bring the audience back in with our second poll question of the day. We're asking very straightforward, what's your market outlook heading into the election right now? Are you bullish? Do you feel good about the markets? Or do you feel like they're overvalued? Do you think, too toppy? Do you feel bearish? Or do you feel sort of neutral and cautious as we head into the election here? We are coming off a rip-roaring year of record highs for the S&P. The Fed just set the new stage for sort of a new era of lower rates, but a lot of that is kind of already priced in. So still a lot of concerns about, as we mentioned, a weakening jobs market, sticky inflation. So some of you might still be anticipating a lot of high volatility in the near term. So let's see what the audience thinks here. Daken, any guesses? Not to put you on the spot.
My guess, given the first, is that it's going to be C. Neutral cautious from this audience is probably the modal outcome, is my guess.
Yeah, that's my guess as well. All right, let's take a look. There we go. Yeah, 60% say neutral or cautious. So you guys are very consistent with your cautious optimism there. I like it. All right, great. Well, I want to mention some of the most, I guess, common myths or misconceptions when it comes to the election, right? There's some who might think they're too noisy these election years, or there are just too many variables and it's just best to stay away altogether. What would you say to those people?
Sure. So where to start on this one? There's a lot of topics to cover. First, I agree. There is so much hyperbole and volatility around this election, but candidly in many elections. And we've seen that over history, this sort of, the extreme nature of the bi-party system ebbs and flows. And right now it's at a little bit more of an extreme than maybe it's been over previous elections. So a lot of hyperbole, a lot of sort of, antagonism that's sort of floating around. And I think our jobs really as investors, as economists, as historians, is to take a little bit of a step back and just try to get a little bit more perspective and try to frame this both in terms of history, but also just in terms of the human experience, which, as we know, when there are humans involved, we're oftentimes going to create chaos. That's the nature of what we do. And so there are four, what I'd call sort of fact versus fiction myths, I would call them, that we get a lot of. And I'm going to spend a little time just stepping through those to provide a little perspective before we get a little bit into kind of where we are currently from an economic standpoint. Four big ones we hear so often and oftentimes so vehemently and adamant. Number one, investors should avoid election years. Sort of this idea that markets dislike uncertainty, and when we don't know who the president will be, therefore we should avoid election years. That's kind of one I get often. Number two, markets are always better when, and then depending on which conversation I'm in, which meeting I'm in, Republicans get elected or Democrats get elected. I hear both sides, both as vehemently, and that's a challenging one to address. We try to do so. And the number three and four, perhaps even more interesting because they really speak to the U.S. business model. One party spends, the other saves. So Republican spends, Democrat saves, or vice versa. And I get that one just as vehemently and adamant. And then number four, one party borrows and the other doesn't. And so what the next handful of slides really try to do is do not take any political stance on this whatsoever. Simply let's just look at some data. Let's just review kind of what took place historically. So chart one, myth one, investors should avoid election year. All we did is look back at the S&P 500 performance during some presidential election years since 1950, right? And each of these has different stories, different levels of inflation, different monetary policy, different fiscal policy, different Congress, Senate, you name it, right? There's lots of different variables, so you have to be careful looking at, what do we have, 11 data points too closely. Nonetheless, when you look at the average election year market return is quite reasonable, quite strong, around 16%. And each of them, again, has their stories, and each of them has their own attribution. But to the extent that someone says, hey, I should avoid election year because it's too volatile or uncertain from a market's perspective because of the presidential elections, at least based on these 11 data points, that appears to be not the case. So sort of point one is take a breath. Capitalism is still at work, regardless of what's taking place from the presidential elections. And while they clearly have influence, it's still only one person. And ultimately, capital markets will survive regardless of what that looks like. So second slide, which is, okay, well, markets are always better when Dems or Republicans get inserted or get elected. Again, when you see data out there, and a lot of these things have been sort of sent around, we look at it, and oftentimes people are cutting the data off at a certain year because it looks a little better, right? What we try to do is, again, let's just look at all data we can get our hands on, and let's just color code by Republicans versus Democrats. And again, same story here. You have to blur your eyes to see any difference whatsoever. Again, red is Republicans, blue is Democrats. And we tried to prove statistically that they're different. Again, there's not a lot of data points here, but by and large, it's the same. Blur your eyes and they all kind of look reasonable. They all look positive. They all look reasonable. And there's no obvious trend. And so, again, point number two is regardless of whether or not your president, your party's president gets elected, markets still do reasonable things. Capitalism is still at play. Remember, capital markets are just an extension of capitalism. And that's just a set of incentives to take capital from those of us that have saved it and to provide it for companies for productive purposes. I provide my money to a company to build a new factory or to take market share. And in exchange, I get return on that capital. And that incentive remains regardless of who's in president. Last couple, perhaps more interesting even than the first, I get this one quite often. There's such an ideology around sort of what's associated with Democrats or what's associated with Republicans. And what we look at is, okay, let's just look at the data. Who is spending and who's not spending? And what you'll notice here, and this is the federal deficit, red is color-coded for those years that we had Republican presidents, and the blue is color-coded for those years we had Democratic presidents. Again, the U.S. government has a very simple model, right? The U.S. government receives revenues primarily in the form of taxes. So you, Kirsten, get taxed, I get taxed, and we send that money, the tax money, into the government. That's what they receive as revenue. They then go spend money for things like Social Security or military or education, you name it. And when you add all that up, all the revenues we receive versus all the money we sent out, if it balances, great. If it doesn't, that's the federal deficit. And that excess is what this chart represents. So if it's in excess, meaning we have to borrow more than we actually have received, that's the y-axis. And again, that's in millions of dollars. So 1 million millions is $1 trillion. And what you'll notice here is that regardless of who the president is, Republican versus Democrat, the US right now tends to run a deficit. They tend to spend more money than they receive. And then what do? They finance it. They finance it with debt. And that'll get to the chart in just a moment. But point number 3 is, by and large, the US has a mode right now of spending more than it receives, regardless of who is in the presidential seat. And that will likely remain true for the near term as well. Last chart in this section, again, just as adamant. Republicans borrow, Democrats don't. Democrats borrow, the Republicans don't. And what we did is the same thing. It's just the US business model is a very clear business model right now. Right now, by and large, we are exporting bonds and we are importing goods and sometimes services. That's how we finance essentially the deficit that takes place. That's a business model. It's really not even very controversial. And what you'll notice is that because we have that deficit, we finance that with debt, which you can see, again, this is in trillions, regardless of which president is in office, Republican or Democrat, that continues to grow and will continue to grow for all intents and purposes based on what we're seeing in the near term as we continue to borrow more than we receive. And that's really what the business model is. And that is a US business model that has given us enormous opportunity. We also are the world's reserve currency, which affords us enormous advantages. Nonetheless, it's not a Republican versus Democratic issue. And the principles of capitalism will remain at play regardless of who ultimately ends up in the presidential seat. So all in, by and large, those are all myths. Investors should not avoid election years. They're normal markets. Markets are not necessarily better when A or B get elected. And same with one-party spending and borrowing. Capitalism remains at play and strong regardless.
And Daken, what about the idea that political gridlock in Washington is good for Wall Street, regardless of who's president? Bruce had the same question I have. He says, what about the importance of divisions such as checks and balances based on Senate, House, and president being not in the same party? Seems to me the economy works better when there's a split.
Yeah, that's a great question. So let's back up a little bit. One of the beauties of our system, while there are flaws to our system, is that it is difficult for any one president, regardless of who the party is, to move really, really quickly on anything. And so what ends up happening is, to your point, Bruce and Kirsten, is that things move a little slower and you have to get agreement. You have to get a plurality, sometimes a majority, to get anything of meaning passed. Even if the president wants to really get something through, if Congress is not on board, it's not going to happen. And Congress will not do something unless it represents their populace and their citizenry, which ultimately votes and keeps them or decides not to keep them in office. So, is there any evidence from a statistics standpoint or a data standpoint that when there's gridlock, markets do better? Not really. Nonetheless, philosophically, our system is very much designed to protect against that risk that someone can ram a bunch of things through without agreement, by and large, across our citizenry, across the U.S. population. And that essentially protects us from, on either side, extremism and things getting moved through that, again, generally people don't necessarily agree with. So point one, to sort of summarize, markets very much dislike uncertainty. And so when there is uncertainty about the future, markets generally don't like that. I think that's definitely true. With that said, we have such a well-designed system relative to other systems. It's very much not perfect, but it's a very well-designed system politically that enough machinery exists to protect us against the extremes that oftentimes just don't get pushed through.
Got it. All right. Thank you for that. So I guess the next question is, where do we go from here? Again, the Fed just kind of all in with their 50 basis point cut, but Fed Chair Powell did say this is by no means the new normal. So what's your view on where we're headed now?
Yeah, so great question. So the thing I don't love right now is that the market is very, very focused because of what's happened really almost since the mid-90s on what the Federal Reserve has done. It's very Federal Reserve focused. And I generally believe markets over the long term should reflect economies. And economies, we sort of step on different forms of scales and change incentives with things like fiscal and monetary policy. But it's very, very reactive to what the Fed is doing. Nonetheless, they're a big buyer. We all know that. They have tremendous amounts of influence. And they're very clear. They are signaling they feel like by and large inflation has come down materially. Remember, inflation went up a lot, rates went up a lot. Inflation has come down and rates have really stayed high, at least depending on which market we're looking at. Market has adjusted and sort of forward rates have moved already lower. But the Fed is very much saying we're pro-growth. We are very focused on trying to get back to a neutral rate, which will balance inflation prices and more reasonable. They don't know what that number is, but they think it's lower than where they are now. And they're willing to sort of lean a little bit more into stimulating growth and being less restrictive than they are currently. That creates a number of different dynamics. First and foremost, one of the risks that's out there, inflation remains sticky. Inflation has a history of the last 200 years of being sticky. Prices move up and they oftentimes don't move down as quickly. Right? It's like your local gas station, for example. When you watch gas prices, if oil prices move up, your gas station moves those prices up really quickly. Incentives are there to do so. But when oil prices fall, your gas station oftentimes will keep gas prices a little high. Again, incentives drive behavior. So my worry is that if inflation is and has a history of being sticky and CPI is not a perfect measure, inflation went up a lot, it's definitely come down. We know that, and you can see that in this chart, but it has this tendency to sort of remain sticky. So if they suddenly give a little juice to the market and we see a tick up in inflation, it could be a bit of a noisy environment. We could see a pause for a while. We could see rates go up, bonds sell off. It could just sort of bounce around. It's not clear to me that we have inflation beaten yet, which remains a risk. Second chart, maybe my favorite that's in this little section is a little complicated, so bear with me here. One of the questions we pose oftentimes to ourselves is, okay, Fed raised rates a lot, right? Credit card rates went up, home mortgages went up, auto loan rates went up. And while that occurred, the consumer sort of yawned and said, yeah, we don't really care. And the question is why? Why didn't that send our economy into a recession when rates went up so quickly? We saw a spike of inflation. Usually when rates go up so quickly, people stop spending as much. They stop borrowing as much because it's more expensive. And that sort of slowed everything down. It didn't happen as fast. And here's there's a number of different drivers of that, we believe. So the Federal Reserve, and we validated this in a couple different ways, put together some really interesting data where they looked at the excess savings by recession. We did something similar. We looked at 8 different recessions. So each line here in this chart represents the excess savings following each of the recession. Many people don't realize it, but in 2020, we had a technical recession. And so each line represents the number of months after that recession. And what you'll notice is that all of them are sort of grouped around the bottom, right? 70, 73, 80, et cetera, et cetera. They're all sort of flat, meaning when a recession happens, people oftentimes lose their jobs, they don't spend as much money, they blow through their savings, and so they shouldn't have a lot of excess savings. But then you see this massive mountain in the middle, 2020, where $2.5 trillion of excess savings existed, a massive amount of excess cash. Remember, the entire US economy is something like $26, $27 trillion. The US consumer held that. We literally had sent it to them in mailboxes and checking accounts, and the US consumer is holding on to that. So when rates went up a lot, there were a number of other drivers, and borrowing slowed, to be clear, but spending really didn't. And spending was one of the drivers of this spike of inflation. We think it's something like 20, 25% of the root cause. And so when rates went up, it didn't stop everything because consumers held so much cash. And what do you notice? We've now burned that through. So $2.5 trillion that we had in excess cash is now gone. You can see a little arrow in the far right. And that's really where the rubber starts to hit the road, right? When rates have gone up, people kind of yawned, but all of a sudden cash is gone. Now is when really high rates really start to matter. And we're watching that really, really closely to the extent the consumer really feels that bite. And we think the Fed may be referencing this almost implicitly in what they're working on with cutting rates. That's where some of the risks now start to play through. And we're going to watch that really, really closely because we think there's an important driver there. Kind of item 2. Item 3, risks abound. Drop me in any country, in any day over the last 200 years, and I will find you 5 major risks. Where there are humans, there is chaos, and where there is chaos, there are risks, and that affects markets no matter what. China has some real challenges right now, and they really tried to move from one type of an economy into a different type of economy. This shows the Hang Seng, where a lot of mainland China companies are listed, and there's been real challenges in the equity markets there. And could that spill over, particularly in sort of the over leverage on the property side, to the U.S. or create a more global risk or risk sell-off? Possible. We're watching that. It's worth noting, really since 2007 through current or through 2022, really, China accounted for a massive portion of global growth. And without that engine of growth, even if it doesn't sort of have a contagion effect where it spills over into our equity markets or causes a recession, the absence of that growth is a risk that I'm also quite worried about, and we're watching quite closely as well. So to summarize and sort of answer your question a little bit more concisely, Kirsten, is U.S. growth is quite good. Unemployment's very reasonable. Inflation's coming down. Those are all good things. With that said, there are, as there always are, some real risks on the horizon, and we're watching those really closely to see how those play through to us. Currently, all said, we think it's a pretty reasonable time, and U.S. Federal Reserve has very much leaned into, we're going to help push on growth. We're going to help make sure that this economy stays fueled, and that is definitely the signal right now.
China still has that drag from the property market crisis. Obviously, that will probably take a few years to shake out.
Right. So from there,
sorry, thought you had another slide. Now, just taking a step back from sort of all the minutia, what's sort of the key takeaway here, I guess, when it comes to markets and the election? We do have a question on sort of valuations right now. Do you think, equity markets can be viewed as too expensive? I think the S&P forward PE is something like 23. It's historically very high. What's your thought there?
Yeah, so valuation is always a little tricky in the short term. First of all, which valuation measure do you use? You can sort of argue them based on lots of different valuations. There's all sorts of preamble in there. With that said, we have an economy that has pretty reasonable metrics, as we've talked about. We have an equity market that has had a really good year, had quite a good last year. Is it a little expensive? It's a little expensive. Yeah. Is it wildly expensive? It's not wildly expensive. And if we see reasonable growth and we sort of manage this, this sort of hopefully soft landing and a return to more reasonable rates, you'll start to see a pickup in earnings, as an example, because there's more stimulus that's out there. It's easier to get financing for projects, and that will sort of start an additional boon. And so the denominator in the PE measure that someone just quoted there will clearly start to improve if we do see additional growth start to pick up. As I mentioned earlier, I have some concerns about where that future growth comes from. There are demographic issues, there are valuation issues, there are monetary issues, all of those things. But all said, I think markets are a little expensive and not crazy expensive.
Now, you mentioned China, obviously, and the issues there, but Lauren is asking about the Middle East. Does the situation in the Middle East threaten the market at all, in your perspective?
Yeah, so it's one of the challenges, great question, is how do you weigh what those types of risks are? How do you weigh the probability of that spilling in? If you look at the beginning of World War I as a great example, that was a risk that was almost unheard of, but there were a lot of building blocks there that just took a little spark, and all of a sudden you have a massive war. Is that the same now? Again, I go back to incentives. So who are the major players right now, and what are their incentives? And most of the major players on a global stage do not have an incentive to go create a World War III, as an example. Could it be a spark? Possible. But I think cooler heads have thus far prevailed, and by and large, the large powers of the world have relied on their own incentives and based on their own objectives to sort of keep that in a much more reasonable stance. Am I worried about it? Yes, I absolutely am. We're watching it closely. We don't like these little sparks that sort of pop up and create risk in a global contagion way, but by and large, global powers have thus far focused on their own agendas, and I think thus far have done reasonable things, and calmer heads have sustained thus far. But we'll watch that closely.
Why don't you continue on with your sort of overall outlook as we step back from
the points I'll make that I think is just really important to keep in mind. So we started with, hey, it's a bit of a chaotic environment. We've seen a bit of an unprecedented move by the Federal Reserve. rates went up, rates may be coming down, inflation went up a lot, inflation came down a lot, we've got a challenging election year, et cetera, et cetera, et cetera. Whenever we sort of get in those moments, I think it's just really important to zoom out a little bit and try to spend a little time just talking about kind of what are the incentives, what are the drivers, what are the behavioral biases that we can think about. Here's the first, and this is really important. I kept a paper file on my desk for a long time where I would just clip out individual headlines from various publications that were always doom and gloom. Right? Imagine the story where Kirsten and I'm walking down the street and I see two newspapers. On my left is a newspaper that says, hey, the world is great, go about your day. And on the right is a newspaper that says, the world's going to end tomorrow. Open the page to learn more. Which of the newspapers am I going to pick up? Right? Obviously, I'm going to pick up the one with doom and gloom. And bad news sells. We all know that. It's something like a 7-to-1 ratio, meaning if my portfolio goes up about 10%, I feel 1 unit of pleasure or joy. If my portfolio goes down 10%, I feel something like 7 units. Right? So it's like a 7-unit pain to pleasure, very, very strong driver of getting our attention because bad news really sells. So this shows a chart, growth in the S&P 500 of $1. And what you can see, all these little headlines: Dow will fall to 6,300, Europe debt defaults are poised to rattle stocks, stocks and bonds will crash. And that gets attention. And so lots of investors, myself included, are inundated with that constantly. Those headlines are constant because that gets attention. And when you hear that much sort of bad news, especially for those investors who are nearing retirement or are a little bit more nervous, or you name it, we all have sort of our emotional biases that can really create challenging conversations and ultimately can make poor decisions for us because we're sort of primed to sell as soon as the market sells off. And remember, bad news sells, and so we're individually constant. It's important to just remember that. Just being aware of that helps us make good decisions. Next chart, one of my favorites. I'm a simple person. I like simple charts. Red dots, blue bars. Let me explain. This shows the S&P 500 every single year. So let's focus on the red dots for a second. Far left, 1980. The red dots represent the worst sell-off in each of those years. Okay, 1980, market was down 17%. 1981, it was down 18%. 1982, it was down 17%, et cetera, et cetera, et cetera. Sort of blur your eyes across the red dots, and what do you notice? Every single year, the market sells off, right? Almost without fail. 16, 17, 18, 34, 40, you name it. Market sells off every single year. So we should expect that as part of a capitalistic system, as part of capitalism representing capital markets, the markets will sell off. That's really important to remember. And that brings us to the blue bars. Blue bars show full calendar year returns, January 1st through December 31st. That includes the red dots in the S&P 500. So again, 1980, market Jan 1 to 12/31 was up 26%, down 10% the next year, up 15%. That includes all the red dots. Blur your eyes, you'll notice that by and large, markets are up. By and large, they're providing positive returns. That doesn't mean the next 40 years are going to look exactly the same. What it does mean is that capital markets have incentive. All of the companies are trying to build good, thoughtful, innovative products to generate profitability because they're incentived to do so. And that provides incentives for us as investors to give our capital to those companies so that we get a return on that capital. And that plays true regardless of what takes place on a daily basis from a political or from an environmental or you name it standpoint. Those incentives drive behavior and will continue to do so. Which brings me to the last slide in this one section before we get to the next poll. Again, growth of $10,000 going back to 1980. I went in and circled some of the big crises that took place. In 1987, for example, the market dropped 20.5% in one day. Global financial crisis right there in the middle of the chart. There were people calling for literally the end of capitalism as we know it. The dot-com burst, the COVID sell-off, you name it. And yet the growth of 10,000 compounds into a massive amount of money because compounding has a way of getting rid of the big things that happen. Over the long term, you simply don't notice that in 1987, the market went down. That is the power of compounding. That is what we're relying on as investors. And if we continue to do so and save more than hopefully we need, you benefit from that enormous power. And remember, that's the thing that we're dealing with even when markets sell off. And if we can make better decisions, you end up with better terminal values of wealth as well.
All right. Well, thanks so much for that run through, Daken. Now it's time for our third and final poll of the day. And we won't be sharing the results of this one on screen, so don't worry. So would you like to reach out to someone from MassMutual to learn more about investment trends around election years or other major sort of catalysts? So feel free to answer that. And while I let the audience take a look at that, I want to get to our first question from Deborah here. She's asking, do returns after a Fed rate cut depend on how much of a market run-up we had during the pause period? I know you did a little bit of research on some of the market correlations with Fed pausing and rate cuts. Any thoughts there?
Yeah, short answer is definitely. Short answer is absolutely. So valuations matter very, very much. The future returns expectations, my future return expectations very much are driven by what is the current valuation. So short answer is yes. There are also a lot of other variables at play. And if I could time markets, I would tell you exactly when we should be getting in and out. We simply can't. So what I do know is markets are a little bit more expensive than they were, definitely. And capital has just become a little less expensive than it was. And so all things being equal, when it's less expensive to get access to capital, that is a pro-growth, pro-equities pressure. Does that mean it's the only pressure? Absolutely not. Valuations being expensive definitely is sort of a counterbalancing there. Nonetheless, if I had rates cut when PEs were 10 or rates cut when PEs were 30, I certainly would prefer that PEs were 10 as an example. That doesn't change necessarily in a dramatic way what I think the next 10 years looks like in terms of equity returns, but it's something to be aware of, and we should always be a little valuation sensitive.
And typically, we're getting some questions about timing around elections as well. Has the timing of U.S. presidential elections mattered for stock market returns, and how much, if so?
Well, so one of the challenging things around these sort of Boolean events, which is we have a president that's this person, then it's that person all of a sudden, is attribution. It's really, really hard to attribute an event like a single thing, which is one person who is a human who puts his or her pants or suit on every single day and has as much influence as he or she can have. That's really hard to sort of tie that back to what took place because there's so many other variables. What was inflation? What is monetary policy? Was it a split Congress House? You name it. Was there a war? Was it a pandemic? All of those things. So we've tried to run some analysis around, month by month, and it's really hard because there's so many other variables that we think matter. I would by and large say, one, if you think you can time down to that level, I certainly cannot. You should spend some real time trying to figure out if that's actually statistically accurate. And then two, we don't believe that we have enough, particularly post-trading costs, post-taxes, post all of the things that take place, enough knowledge or expertise to really get it down to that level of precision. It's just really, really difficult to do.
Makes sense, yeah. I know you want to avoid politicizing too much about a specific candidate, but Joseph is asking, what would the impact of a landslide victory for Vice President Harris mean for stocks and for bonds?
Yeah, so there are a couple of aspects to that question. It's a good question. A couple of thoughts. One is landslide is different than a normal victory, and I assume he's asking that on purpose. A landslide creates a little bit more of a mandate, regardless of which presidential candidate wins, and that is a little bit different than a slight election victory. So that's important to sort of set aside for a second. Barring any circumstance where it's a massive sweep on either side, and I think the likelihood of that is not zero, but pretty close to zero. Barring that circumstance, it really goes back to my point about our system is designed to move slowly, and our system is very much designed, including how we have midterm elections and sort of much more frequent turnover of politicians, congressmen in particular, congresspeople in particular. That slows it all down and creates sort of this mandate for Congress people to focus on what their populace wants them to do. All that means, I think the likelihood that if there's a landslide on either side, it's unlikely to have the actual impact of some of what the candidates are saying they're going to do, because they just won't have the ability to do so. So even if they make their very broad and grand election debate statements, media statements, the likelihood that they get all of those things through is almost zero. The likelihood that they get most of them through is quite low. And as we've seen in history, once someone gets elected, they will tend to move more towards the middle because Washington requires you to do so. You have got to make compromises in order to get anything done. And I think, if anything, that will be even more extreme for this election, not less so.
I agree. So Jeffrey's asking, you mentioned markets hate uncertainty. What impact will not knowing who won for a couple of weeks have on the market? I mean, we try to avoid short-termism, but do you have any immediate reaction to that?
Yeah, I mean, there are some important implications, and right now there are lots of conversations that are happening across lots of different companies and investors who are trying to figure out, how does this president or that president affect their outcomes, and are they adjusting accordingly? So when that occurs, and as I think you said Justin's question, over the subsequent couple of weeks as we're sorting those things out, the same thing will play through. People will still be doing that and trying to figure out the implications of it. Once that's locked in and done, I think, again, we all sort of understand this capitalistic framework and everything is sort of off and running. So long-term impact, I think, is close to zero. Short-term impact, there may be a couple of projects that get put on hold, some questions about, for example, the carbon process, some questions about tax. But again, our system is designed to be slow, and I think the final announcement has very little to change that.
Just going back to the markets for a second, Jamie has a question about valuations. In regards to your answer on PE valuations, does the growing number of investors and the declining number of public companies play a part of us seeing a new high watermark for PE valuations?
Yeah, so I'd love to have a conversation there around these, some follow-up questions there, but I think the question that's sort of coming out of that is the fact that we have so many private companies who now have access to different levels of capital, both on the private credit and private equity side. Does that sort of change our benchmarks for how to think about PE? And the short answer is yes, absolutely. Like if we could do it, ideally, we would have sort of access to all public and private companies. We'd have access to all income statements. We'd have access to all sort of valuations in real time. So we could get a very much more precise view of earnings and valuations and credit usage and delinquencies and all of those things. We don't. But the fact that that is changing, and there are so many, there's an enormous number of private companies, the vast majority of US companies are private companies, it changes sort of our thought process there, and the more data we can use to inform that, the better. With that said, I would say the public versus private ratio isn't changing that quickly. What's changed is that now the private side has much more access to capital. And so we're seeing it much more in the public sphere than we were before. But short answer is yes, absolutely. We should continue to rethink that as that private versus public ratio changes over time.
You mentioned obviously a lot of divisiveness and volume and noise about the political impact. So how best, I guess, what's the best way to avoid fear mongering when it comes to all of the chaos around decision making around the election?
Yeah, so a couple thoughts. One is avoid all of those conversations at any holiday tables. There's no upside. Let me warn you ahead of time. There's just no upside. Talk about something else. Two is when someone sends you a piece that has a bunch of data that tells one story or another, spend some time trying to understand the data. What did it look like for the 10 years before they happened to randomly cut it off, as an example? Can you get a better version of that? Is there a more objective source? So much data that I see sent around is just cut off or biased or manipulated, including the access to tell a certain story. And so always try to just use your brain to think through, is this really accurate? Is this really objective? That's sort of the second point. Three is I'd always recommend zoom out. Like Munger said, invert, sort of the same idea. Always zoom out. Try to sort of take that and add a little bit more perspective. Humans have very similar drivers from a mental behavioral standpoint, and have for several 100,000 years, and that's really not going to change. So the more we can take this small moment and zoom out to the larger picture and drivers and understand what that looks like, I think it increases the probability of us making good decisions. And again, go back to point number one, avoid all these conversations at holiday tables, please.
That's wise advice. Bruce has another question. Is it a problem that Americans have not changed their purchase habits, even when costs have increased by as much as they have? He's making a point about many using credit cards, creating larger risk in general, huge cost to pay those credit cards back.
Yeah, good question. So we're looking at that closely. If you look at delinquency rates, so delinquency rates, how I'm defining them right now are the percentage of loans that are 90 days out, meaning they haven't paid their payments in 90 days. If you look at auto and credit card, there's a slight uptick in delinquencies in the 90-day sphere. So we're watching that. To the question, rates went up a lot. credit cards and autos were still paid quite well and there really weren't any issues. And now as rates have stayed up, there's been a little bit more of an issue, and we're watching that. Mortgages and student loans, interestingly, are not, and those are, for a handful of reasons, a little bit slower moving. They're a little bit more fixed rate than they are variable rates. That may be part of the issue. So that's sort of first part of that answer. The second part of the answer is increasing prices have a way of sort of self-fixing. What I mean by that is, you're right, in the short term, people may finance that a little bit more. They may take some of their savings down to pay for things that are a little more expensive. Over a reasonably midterm to long term, eventually that has to stop. You eventually run out of space. And we're not seeing, especially relative to like a 2007, 2008, or 97, 98, we're not seeing the same levels of leverage, debt that was taken on before. Interestingly, consumers sort of seem to have learned that lesson. And because that lesson has hopefully, by and large, been learned, I think that creates less risk in this environment. So it's not as if all of a sudden everyone has to sell a house or everyone starts defaulting on credit cards. It doesn't have that same level of risk that it did in some of the prior sell-offs, which is a good thing. It means that, again, it leans much more towards the soft landing than the dramatic sell-off that are oftentimes leverage or debt fueled that can take place.
So going back to sort of, it's good or bad for the markets if XYZ party wins. What about, have you done any research on sort of sector correlation, and like whether, Dems winning is good for certain sectors or Republicans for others, or is it just really depend on the year?
If I knew, so if I could take what policies were being promised and then have accurate data as to which of them were actually pushed through, I could tell you very quickly which sectors will benefit. The reality is I can't, because they say X, they oftentimes implement Y, which is very different than what actually gets signed into legislation, which is Z. So it's really, really tricky because there's so much back party channeling, so much negotiation, so much that sort of, again, moves towards the middle and candidly moves towards the incumbent, that because so many of the policies have already been implemented, that I think the attribution is really, really tough. The other piece of it is you'll notice, as if you look at probability that one president wins or the other, as those probabilities change, there's some live market data that's out there, you can actually see there's a little bit of attribution in the sectors themselves. They start to adjust. Point being, the market is already adjusting for some of that knowledge in sort of real time. There's no arbitrage to be had there. In other words, it's a fairly efficient information dissemination process through there, I think.
Got it. And when you say incumbent, just to clarify for my sake, do you count Harris as incumbent?
Good question. Yeah, I would say I've meant it at the party level. That's a good question.
Okay. All right. I guess just a minute left here. So just to wrap up, for advisors looking to minimize clients' worries during such a volatile, uncertain time in the market, what advice do you leave them with? What would you have them? What are some tips they can keep in mind for their clients?
Right. So for advisors working with clients, number one, have a plan in place. Understand what it is that the client actually wants to do. If you have a plan in place, you are so much higher likelihood to stick to that plan. An advisor can often sort of act as almost like an accountability partner to clients who are struggling in the moment. Remember this 7-to-1 ratio of pain to pleasure. When the market sells off, market goes up 10%, clients go, yeah, it's supposed to go up. Markets go down 10%, and clients go, oh my gosh, I'm not going to meet my retirement goals, and forget all of the data that we've talked about. Sort of your amygdala kicks on, everyone really panics in the moment. So having a plan really helps them stick to that. Remember, point 2, markets sell off. It's a healthy process. When markets sell off, there's sort of a realignment. Companies can acquire other companies. The strong ultimately survive. That's what capitalism is based on. And remind them of that. Number 3, zoom out. Try to take a bigger perspective for those clients that are in that moment of panic. Try to lend them some sort of information about, hey, we're looking at 10 years, 20 years, 50 years, depending on where they are in their retirement process. Here's where your goals are. And then lastly, those moments can be good opportunities for just good conversations about, look, if this was really painful when the market sold off 10%, let's have a conversation. Maybe there's too much risk in your portfolio. Maybe you need a little bit more of this, a little bit more of that, or we think there's a risk of inflation. Maybe we add these asset classes, and that sort of opens up the door to good conversations. The worst thing you can do is sort of ignore those fears, acknowledge them, validate them, and then move towards, here are the things in place we're doing that we can sort of help move you into that next level.
All right. Well, thank you, Daken. That's all very sage advice. That does it for today's webcast. Thank you to everyone who submitted questions. If we were unable to get to them, someone from MassMutual will personally get back to you. Special thanks again to Daken for joining me, and thank you all for attending. And just a reminder, a recorded version of this presentation will be available shortly after the call is completed, so you will get that deck for those of you asking. And don't forget to fill out that survey before you leave us. Everyone have a great Thursday, and remember, don't talk politics at the dinner table. Take care, guys.
Thanks, everyone.